Have you ever dreamt of becoming a millionaire? It might sound impossible, especially if you're on an average income. But what if I told you that you could achieve this dream with just $447 a month? That's right, less than $15 a day could set you on the path to financial freedom. In this video, we're going to break down how you can retire a millionaire in 30 years by investing with an average return of 8% per year. So, if you're ready to turn your millionaire dream into a reality, let's dive in. Why 30 years? Why 8%? These might seem like random numbers, but they're grounded in sound financial planning. 30 years is a common time frame for long-term goals like retirement. Historically, the stock market has delivered average annual returns between 7 to 10% over the long term. For instance, over the past 30 years, the S&P 500 index has delivered a compound average annual growth rate of 10.7% per year. We're choosing 8% as a reasonable and even conservative estimate for this scenario. The earlier you start, the more time your money has to compound and grow. But even if you haven't started yet, don't worry. It's never too late to begin investing in your future. The key is to start now and stay consistent. Think of it like planting a tree. You wouldn't expect it to grow into a mighty oak overnight, would you? It takes time, care, and patience. By investing consistently over 3 decades, even small amounts can grow into something substantial. It's about planting those financial seeds and nurturing them over time so that you can enjoy the fruits of your labor in the future. Now, let's address that 8% average annual return. The stock market, over the long term, has consistently delivered average annual returns between 7 to 10%. Of course, the market has its ups and downs. Some years will be better than others, but the key takeaway here is that over the long haul, the market tends to go up. By staying invested and riding out those market swings, you allow your investments to benefit from the power of compound growth. So, we've established that 30 years is a reasonable time frame, and 8% is a realistic return to aim for. Think of compound interest like a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and bigger. Similarly, with compound interest, your money earns interest, and then that interest earns even more interest. The earlier you start investing, the more time your money has to work its magic. So, don't underestimate the power of starting early and staying consistent with your investments. Now, let's unlock the secret ingredient that makes this millionaire dream a reality: compound interest. When you invest your money, it earns interest. But with compound interest, you earn interest not just on your original investment, but also on the accumulated interest. Over time, this compounding effect creates exponential growth. The longer your money compounds, the more powerful this effect becomes. That's why starting early is so crucial. Time is money. Now, let's get down to the nitty-gritty and see how this translates into real numbers. We can calculate the future value of your investments using a simple yet powerful formula called the future value of a series. FV equals P times the quantity of 1 plus R raised to the power of n minus 1, all divided by R. Let's break it down. FV stands for future value. That's the $1 million target we're aiming for. P represents the periodic payment, or how much you're investing each month. Now, let's plug in the numbers and solve for P. When we plug those numbers into the formula and solve for P, our monthly investment, we get approximately $447. That's right, by investing just $447 each month for 30 years, with an average annual return of 8%, you can retire a millionaire. Over time, those seemingly small, consistent contributions add up to a significant sum, especially when coupled with the magic of compounding returns. The earlier you begin, the less you'll need to invest each month to achieve your goals. However, even if you're starting later, don't be discouraged. The key is to start now and remain consistent. All right, let's cut to the chase. We've talked about 30 years, 8% returns, and the magic of compound interest. Based on our calculations using the future value formula, you would need to invest approximately $447 per month. Small changes in your spending habits can free up enough cash flow to make this investment a reality. Now, let's talk about the elephant in the room: time. The earlier you start rolling that snowball, the bigger it gets. Those early years of investing are crucial as they create a solid foundation for future growth. So, what's the takeaway here? Start early. The sooner you begin investing, the less you'll need to contribute each month to achieve your financial goals. But remember, even if you're starting a little later in the game, don't be discouraged. The important thing is to start now and stay consistent with your investments. Now that you know how much to invest each month, the next big question is, where do you put your money to work? One popular and effective approach is investing in the stock market. You can do this through index funds or exchange-traded funds, also known as ETFs, which track the performance of a broad range of companies. Another option is mutual funds, which pool money from multiple investors to buy a diversified portfolio of assets. Real estate investment trusts, or REITs, offer another avenue for investment growth. Diversification is essential for managing risk and maximizing your chances of success. Think of it this way. If you invest all your money in a single stock and that company goes bankrupt, you could lose everything. But if you spread your investments across different asset classes, sectors, and geographies, you're less likely to be wiped out by a single event. Diversification helps to cushion your portfolio from market volatility. So, how do you diversify your portfolio? A good starting point is to invest in a mix of stocks and bonds. Low-cost investing. Keeping more of your hard-earned money. When it comes to investing, fees matter. Every dollar you pay in fees is a dollar that's not working for you. That's why it's crucial to choose low-cost investment options. One of the best ways to keep your investment costs down is to invest in index funds or ETFs. These funds typically have lower expense ratios compared to actively managed funds because they don't require the same level of research and management. An expense ratio is an annual fee charged by a mutual fund or ETF to cover its operating expenses. Even a small difference in expense ratios can make a big impact on your returns over time. For example, a 1% difference in fees could mean hundreds of thousands of dollars less in your pocket at retirement. Look for funds with low expense ratios, such as Vanguard's VTSX, the Vanguard Total Stock Market Index Fund ETF, or VOO, the Vanguard S&P 500 ETF. These funds offer broad market exposure at a fraction of the cost of many actively managed funds. Remember, the goal is to keep as much of your hard-earned money as possible working for you, so choose your investments wisely and be mindful of fees. We've covered a lot of ground, from the power of compound interest to choosing the right investments. But there's one crucial element that ties it all together: time. Think of time as your secret weapon in the quest for financial freedom. The earlier you start investing, the more time your money has to work its magic. It's like planting a tree. The best time to plant a tree was 20 years ago. The second best time is now. The same principle applies to investing. The sooner you start, the more you benefit from the snowball effect of compound growth. Those early years of investing are like giving your money a head start, allowing it to grow exponentially over time. Let's imagine two individuals, both aiming to retire with $1 million. One starts investing $447 per month at age 25, while the other waits until age 35. Here's the kicker. The person who starts at 25 will have contributed significantly less overall but still reaches the $1 million mark at the same time. Why? Because time is their greatest ally. Those extra 10 years of compounding make all the difference. It's like the early bird getting the worm, or, in this case, the early investor reaping the rewards of compound growth. Now, we know life happens. There might be times when you're tempted to pause your investments, especially when the market takes a dip. But here's the thing. Consistency is key, even when things get bumpy. Think of the stock market like the ocean. It has its ebbs and flows, its calm days and its storms. But over the long run, the tide always rises. The same goes for the market. There will be ups and downs, but historically, it has always trended upwards over the long term. When you invest consistently, you're essentially riding those market waves. You're buying low during the dips and high during the peaks, averaging out your returns over time. This strategy is known as dollar cost averaging, and it's a powerful tool for long-term investors. So, don't let market fluctuations derail your financial goals. Stay the course, remain disciplined, and keep investing consistently. Remember, time is on your side, and by staying consistent, you're setting yourself up for financial success in the long run. We've talked about the incredible potential of long-term investing, but let's be real for a moment. The market doesn't always go up. Just like the weather, the market can be unpredictable. There will be sunny days of growth and stormy days of decline. That's just the nature of the beast. But here's the good news. As long-term investors, we're not playing a short-term game. We're not trying to time the market or predict every up and down. Remember that roller coaster analogy? We're strapped in for the entire ride, not just trying to hop on and off at the most opportune moments. Market volatility is normal. It's actually healthy. It's what creates opportunities for growth in the long run. Think of those market dips as discounts, a chance to buy more of your favorite investments at a lower price. The key is to not panic when the market gets stormy. Don't make rash decisions based on fear or emotion. Remember why you started investing in the first place, to build a secure financial future. And that future is built on a foundation of patience, discipline, and a long-term perspective. Let's talk about managing risk over the long term, rebalancing and inflation. Rebalancing is like spring cleaning for your investment portfolio. Over time, your portfolio's asset allocation can drift from your original plan. Rebalancing involves selling some of your winners and buying more of your laggards. This helps manage risk and keep your investments aligned with your goals. Inflation erodes the purchasing power of your money. Investments, particularly stocks, have historically outpaced inflation. Stay invested to maintain your purchasing power and ensure your retirement nest egg lasts. So, you're ready to embark on your journey to becoming a millionaire. The first step is to open a brokerage account. Companies like Vanguard, Fidelity, Robinhood, and others make the process straightforward. Most platforms will guide you through the account setup process. Once your account is open, it's time to fund it. Remember, our target is $447 per month to reach that $1 million milestone in 30 years. Now that your brokerage account is set up and funded, it's time to automate your investments. Automate transfers from your bank to your investment account. This ensures you pay yourself first and build a disciplined habit. Use tax-advantaged accounts like a 401k or IRA for significant tax benefits. Take full advantage of employer 401k matching contributions. Automating investments and using tax-advantaged accounts can help you reach your millionaire goal. Let's look at a couple of scenarios to illustrate how this works in practice. Imagine two people, both dreaming of retiring as millionaires. Sarah, a savvy saver, starts investing at 25. She consistently puts away $447 each month, achieving that $1 million goal by 55. Now, meet John. He starts a bit later in life, at 35. To reach that same $1 million milestone by 55, John needs to invest more aggressively, around $1,061 per month. This highlights the incredible power of starting early. Sarah, by giving her money that extra decade to compound, enjoys the luxury of investing less each month while still achieving the same result. But remember, John's story is still a success story. It's never too late to start investing in your future. The key takeaway here is that regardless of your starting point, with discipline and a sound investment strategy, you can pave your way to a $1 million retirement. So, there you have it. We've walked through the steps to potentially retire a millionaire by consistently investing just $447 a month over 30 years. Remember, this isn't about hitting the lottery or inheriting a fortune. It's about harnessing the power of compound interest, making smart investment choices, and staying committed to your long-term goals. Starting now is crucial. The earlier you begin, the more time your money has to grow and compound. But even if you're starting a bit later, don't be discouraged. It's never too late to take control of your financial future. Remember these key takeaways. Invest regularly, even small amounts, and watch your money grow over time. Don't get sidetracked by market fluctuations. Stay focused on your long-term goals. When in doubt, consult with a financial advisor to create a personalized plan that aligns with your unique circumstances. Becoming a millionaire might seem like a distant dream, but it's a dream within reach for anyone willing to start today and stay the course. Remember, the journey of 1,000 miles begins with a single step. Take that step today and start building the future you deserve.